Amazon saved the stock market on Friday. It posted a 13.5% gain, lifting the NASDAQ 100, the composite, and the S&P 500. That comes right after the S&P 500 had its worst day since October 28, 2020, when Facebook tanked 26%. It was a horrendous day, and this was a huge bounce back, but it doesn't mean the stock market's out of the woods right now. Yes, we got the S&P 500 up 2 straight weeks, as well as the NASDAQ 100 and NASDAQ Composite. And you have the Russell 2000 snapping a 4-week losing streak this past week. However, there's a fork in the road that the market finds itself in right now. We're going to get into all of that. There's a case to be made for the bulls, and there's a case to be made for the bears. What we have to do as traders is to not necessarily align ourselves with one side or the other, but to let the market tell us which side we should be on. So often we're trying to tell ourselves, hey, I'm a bull, I'm a bear. Instead, just say, hey, the market's pushing me towards being more bearish, or the market's pushing me towards being more bullish. But when we have to make our own opinion and say, hey, I'm bullish, therefore the market's bullish, or I'm bearish and the market has to be bearish, that's where we get ourselves into trouble. So don't trade what you think, trade what you see. And right now, we're at a crossroads here. It could go either way, and I'm not trying to just play both sides of the fence here. I'm really being serious here. I can see an argument on an hourly chart that looks very bullish, but I'm also seeing on the daily where things could get really ugly in the weeks and months to come, especially with earnings out of the way. Because it was the last 2 weeks where the market was profitable. It was also in conjunction with the 2 most busy weeks of earnings that we'll have this entire season. So now with all the big tech companies out of the way, including the FANG stocks, plus most stocks in general having already reported, the market's going to start shifting its focus away from earnings and more towards the headline risk. And what's the headline risk? Ukraine. You also have the stock market being on the wrong side of the Fed. There's a lot of headwinds to be dealing with here. So one of the big things for me is when there's a lot of uncertainty in the market, I pull back on my exposure to the market. Yes, I'll still trade the market, but I don't have to be 100% long, 80% long, or even 50% long. I can get by just fine being 20, 30% long or short on the market, depending on which direction the market wants to take me. You also had the 10-year yield creeping up right now. It's at 1.93%. That's the highest that it's been in 2 years. That's not good for tech because it increases the borrowing costs for them. And there's a lot of speculative names in that tech sector. And the tech sector is what has fueled the stock market for years now. And when the yields go up, disposable income goes down. That means there's less money for consumers to be able to buy tech products and pretty much all products in general. But even with the S&P 500 down on the year, the NASDAQ down on the year, the Russell down on the year, does that mean every sector is down? No, there's actually 2 sectors that are still up on the year. That would be energy and financials, with energy up over 76% since the beginning of 2021 and 26% so far this year alone. Then you get the financials, they're actually breaking just above break even on the year as well. So there is some sectors that have not fallen apart yet. And so February will be really key, especially with oil, because if we start seeing the selling come again and we see the oil finally start to see some profit taking, is that going to tank the rest of the market even more so, because energy is not providing that safety outlet for investors to go into? Before I get into the charts here, make sure to like and subscribe to this video. Hit the join button down below so you can get all my market research each and every day. That's going to include all of my watch lists and the stocks that I'm watching each and every day, the most intriguing charts that I come across, and updates on all the FANG stocks and the S&P 500, the Russell, and the NASDAQ. So check that out. Click the join button below and start getting all my research today. Now, let's start off and look at this Amazon chart here. You're going to see on this Amazon chart, yeah, it was a pretty good day for it on Friday. That was after the horrendous sell-off on Thursday that took it down like 7 or 8% because of the Facebook earnings. But are we really at a place where we want to buy Amazon stock? No. Why? It hasn't done anything in about a year and a half. I mean, we take this trend line here and we can go all the way back to August, and it has yet to really break out. Yes, it broke down a little bit here, couldn't sustain the move lower, and it broke back up into the range. But to the upside, it's the same story. A couple of breakouts, but they couldn't be sustained. False breakout here and a false breakout there. That's not really the kind of charts that you want to be going after. And now we're back into the middle of this range. So for now, with it trading below the 200 and the 50-day as well, is there really a reason to be trying to trade Amazon? I would say no. It's in a sideways pattern like it's been, with false breakouts to both the downside and upside, so the stock can't really be trusted. I would say stay away from it. And now let's get to our beloved SPY, which we tend to go over quite a bit. From the bearish standpoint, I'll get to the bullish standpoint in a second. You have this head and shoulders pattern. Left shoulder right here, head, and then you got a right shoulder that's trying to form. It's nowhere near confirming just yet, but if you want to know where to watch for a possible confirmation, it's going to be about 427 on SPY. So if it breaks below this neckline here, you're going to have a confirmed head and shoulders pattern. You also have declining resistance that I would say be very careful about right now, because there's a good chance that we could hit that on Monday. And if it can't break out, that might be where you start seeing the attempt to complete this head and shoulders pattern. There's also a little bit of short-term resistance that you want to be aware of going into the new week. It traded just above it for a little bit on Friday, but then fell apart right there at the end to close just below significant resistance there. So 2 levels of resistance above, a level of support below that we want to be watching going into the week. Now, how about the bullish case? There's this cup and handle pattern that's really caught my attention, and I could absolutely see where this cup and handle pattern could get confirmed. Let's go to the hourly chart here, and you'll see exactly what I'm talking about. But no doubt, we've had this downtrend, and we popped, and then we tried to sell it off again, but we couldn't make new lows. So then on the hourly, we have this massive rally, like 300 plus points on the S&P 500. And then we start to sell off again. But in the process of this sell-off, you have a gap that has to be filled right there from February 3rd. Get into that gap here, and most gaps like to be filled. Then you have a legitimate argument that this is a cup and handle pattern that's forming. Now, what is a cup and handle pattern? Let's go to my other chart with TradingView to show you exactly what I'm talking about here. First off, a cup and handle pattern is exactly what it sounds like. It looks like a cup with a handle. Go back to late January. This is where the cup and handle pattern starts to be formed. It comes all the way down. And then from there, you're going to form the handle. So once this pattern breaks out and above this cup and handle, then you have a significant breakout that's unfolding here. You can say the same thing about the Qs. And we'll get to this one in a little bit more detail here, especially with the daily chart. But on the hourly chart, you're seeing the same kind of cup and handle pattern that's forming here. So if it can break above these highs from Wednesday, you have a legitimate chance at confirming the cup and handle pattern. But again, acting on it is being patient to let the patterns confirm the direction that they're wanting to go. You don't want to get in front of this pattern confirming or not confirming, because to the downside, just as we laid out, there's an overarching head and shoulders pattern being formed on the S&P 500. And then when we go to the NASDAQ, you have the same thing there as well. This is the NASDAQ 100 QQQ, left shoulder. Then you got a head being formed here. And then you got the right shoulder. Where does it confirm at? Well, if it breaks below the January lows, it's confirmed. There's a lot of support right here off of this angle coming off of the left shoulder low and the right shoulder low, that once that line is broken, you have a head and shoulders pattern in place there as well. So despite the cup and handle pattern that gives you a potential short-term bullish scenario, you got to be very careful, because there's an overarching theme of a head and shoulders pattern in this market. Also note too, on the Qs, you have some resistance overhead that's worth noting. It's tried to break above it with the Wednesday rally, could not do it, sold off. Massive sell-off with the Facebook earnings. So it has a lot of damage repair that it needs to do. If it can get back above the Wednesday highs, again, you confirm the cup and handle pattern, and you break this declining resistance level just above. You also have some other resistance when it broke below this resistance level back in mid-January. So that needs to also break as well to the upside to really get the bullish engines moving in the right direction again. Now, what's the takeaway with this all? There's a bullish scenario and there's a bearish scenario. Which one should you be? Most of y'all watching this have already determined what you're going to do in this market. I haven't. I'm going to let price show me on Monday, on Tuesday, on Wednesday, Thursday, and Friday. I'm not going to put my will on the market, because it's ultimately the market that decides, not me or what I think that it should do. I'm going to let the direction that the market chooses for me be the direction that I trade. If it doesn't give me a direction and we just get more chop, much like what we saw at the January lows, I'm going to hold off until we get a definitive break higher or a break lower. I see there's a lot of risk out there. There's a good chance that you're going to see some of these headwinds come back into the market now that we're clear of the major earnings reports, and they could wreak havoc. But until we actually start seeing that play out, it's just a theory. You got to let price show you what it wants to show you and not get ahead of it. If you enjoyed this video, I'd encourage you to like this video and subscribe to the channel. Subscribing is huge. It helps me continue to build my YouTube channel and provide you with these excellent videos each week. Again, make sure to click on the join button below and get all my market research that I provide the members with each and every day. It's fantastic. And let me know down in the comments below, what are your signals? What are you watching for in the week ahead to determine whether you're going to be bullish or bearish in the week ahead? Love to hear it. Thank you guys, and God bless.